The Shannon School of Business Small Business Development Center is pleased to present Entrepreneurs in Action, a series of short videos designed to help business owners better understand some of the issues with which they may struggle. Developed by the business professors of Cape Breton University and featuring successful entrepreneurs, these videos provide viewers with the ability to ask the right questions of themselves and others to get the answers they need in order to succeed.
Hello, my name is Derek Hayes. I'm an assistant professor in the Shannon School of Business here at Cape Breton University and presently chair of the Atlantic School of Chartered Accountancy. Business is all about making decisions. What do I sell? Who do I sell it to? How much do I sell it for? Can I make a profit? And whether or not I can get financing. So why accounting? Well, accounting provides the stakeholders with the information necessary to make those informed business decisions. This module will introduce you to a concept called the accounting cycle, which classifies, summarizes, and reports the transactions that have occurred during the period. This is normally shown by way of a set of financial statements, the balance sheet, statement of retained earnings, and the income statement. At the end of this module, we'll provide you with the tools so that you can perform a proper financial statement analysis and make those informed business decisions yourself. I hope you enjoy and learn from this module. Thank you.
The purpose of accounting is to provide reliable financial information to the people who make decisions for your company. Internally, people like you who are looking for cost-effective directions in which to take your company. And externally, people who will judge your company's performance, like banks and investors, and decide whether or not to provide you with loans or equity investments. This calls for an understanding of the accounting systems, which will analyze, record, and report reliable accounting information for you. This won't cut it. This will. Because this is an age where information is at your fingertips, whether it comes from the internet or from a software accounting package. All you need to do is get a grip on the basic accounting principles. Let's take a closer look at the tools of the trade: the balance sheet, the income statement, the equity statement, and the cash flow statement. By understanding what to do with these 4 simple sheets of paper, you can rule any financial empire in the world, or at least understand what your own business is doing. But before we open our mouths, we need to learn how to speak accounting. And the first words you learn are assets, liabilities, equity invested and earned, revenue, expenses, gains or losses. These are the things that will be used to make up your financial statements. Assets are things that are owned, like property, vehicles, equipment, and cash. Liabilities are obligations, things owed to other people that you'll pay at some future date with cash or services. Equity is what you owe to yourself, the business owner. It could be an investment or claim to past earnings. Revenue and expenses, gains and losses are pretty much what you'd expect. Now here's a little formula for you to remember. When we say assets are equal to liabilities plus equity, we end up with the first of our basic accounting tools, the balance sheet. The balance sheet shows the financial condition of an organization at a specific time, like a snapshot. And because it's called a balance sheet, the 2 columns of entries must always be in balance. To illustrate this, let's take an imaginary company. How about Caitlin's dog grooming? Caitlin, the proprietor, has invested $25,000 to start a dog grooming business. Her opening balance sheet would look like this. Assets, cash, $25,000. Liabilities, owner's equity, Caitlin's, $25,000. Total assets, $25,000. Total liabilities and owner's equity, $25,000. If Caitlin had started a corporation instead of a proprietorship, she would make her equity investment of $25,000 by purchasing common shares in her business, and the opening balance sheet of Caitlin's Dog Grooming Limited would look like this. Assets, cash $25,000. Liabilities, common stock $25,000. Total assets $25,000. Total liabilities and stockholders' equity $25,000. The difference in presentation lies in the equity invested section of the balance sheet. A proprietorship has a capital account, whereas in the corporation, the investment is in common shares. Let's use the corporation model for our purposes. As it grows, it will need more capital, and this will take the form of either debt or equity financing. Equity financing is when the corporation sells additional shares, in which case new shareholders will be looking for dividends and a growth in the value of their stocks. Debt financing is when the corporation borrows money from an external source, usually a bank, and banks require regular payments of principal and interest. So what'll it be? Sale of stock or loan from a bank? Oh heck, let's try both. Since this is a hypothetical corporation, Caitlin can sell stock to friends and family and find a friendly bank. In the real world, it can sometimes be a whole lot harder. So Caitlin issues 20,000 shares of $1 per common stock for $20,000 in cash. And she also borrows $35,000 in cash on a 5% one-year promissory note. Let's say she uses the money to buy land, a building, equipment, a truck, an insurance policy, and inventory. This is some kind of dog groomer. All of these activities have to be recorded somewhere in a basic accounting system, and they have to be recorded as either a debit or a credit. As we've said before, the accounting system must stay in balance, so debits have to equal credits. This is called double entry accounting. One more time. Debits equal credits. Now let's look at the effects of debits and credits on the 6 accounting elements we mentioned earlier. Whenever a financial transaction occurs, it is analyzed to see when it should be recorded and what accounts should be increased or decreased. Assets increase debits and decrease credits. Liabilities decrease debits and increase credits. Equity, decrease, increase. Revenues, decrease, increase. Expenses, increase, decrease. Owners' investments, decrease, increase. Dividends, increase, decrease. Gains, decrease, increase. Losses, increase, decrease. Whew. All transactions are listed in the order they occur in a journal. A normal page will be set up like this. Let's try a few. On January 1st, 2010, Caitlin's Dog Grooming Limited purchased a $25,000 truck for cash. Asset. Say it with me. Increase debit, decrease credit. On January 7th, the company purchased office supplies for $2,500 on account. On January 12th, the company paid $1,750 on account towards the office supplies purchased on January 7th. This will continue until all the journal entries for January are entered and transposed to the appropriate accounts. At the end of the month, the information gathered can be used to produce a trial balance. It is from the trial balance that these very important company financial statements will flow. The income statement reports on the company performance and shows whether there was a profit or loss. The equity or retained earnings statement shows changes in shareholder equity from year to year. The cash flow statement reports on the yearly movement of cash by the company. The balance sheet. As we heard earlier, the balance sheet is a snapshot of the overall financial health of the company and is the source of information used by other financial statements. Let's visit Tracy Campbell of Cape Breton Resorts. Hello, Tracy. Could you explain the difference between short and long-term creditors?
A short-term creditor is a creditor that you would typically pay off in your current operating cycle, which for most companies would be a year. A short-term creditor typically doesn't have an interest component or a security requirement, typically net 30, 60, 90 days, whereas a long-term creditor often has an interest component and very often has a security component required. An example of a short-term creditor would be Nova Scotia Power or Alliant Home Hardware. A long-term creditor would be in the nature of a leasing company, a bank loan, something to that nature would require longer than a year to pay off.
What value do financial statements bring to decision makers such as yourself?
I think typically when people think about financial statements, they think about general purpose statements and the end users being bankers, lenders, investors. In my role, financial statements, I look at them a little differently. I don't look at my financial statements necessarily at the end of the year. I look at my financial statements every month. For an entrepreneur or somebody who is in business, I think that looking at your financial statements monthly allows you to determine where you are to budget. It may change the course of your actions for the year in terms of you may change your pace, you may change your product offering, you may change staffing levels. It allows you to predict cash flow, which in turn gives you some insight into your capital purchasing, those kinds of things. So I think for an entrepreneur or somebody in business, they look at financial statements much more regularly, perhaps, than an investor or a lender who may be looking at them at the year end.
Tracy, can you explain what an operating margin is?
Typically when we're looking at an operating margin, we're looking to see the net income before taxes and interest that each dollar of revenue brings in. So typically when analysts look at an operating margin, they compare them year over year, and clearly when an operating margin is increasing, then you're bringing more income in per dollar, per revenue dollars.
Explain debt-to-equity ratio.
The debt-to-equity ratio basically is the total liabilities a company has versus the total shareholder equity a company has. So basically what we're saying is it's the total amount of debt that lenders, creditors have committed to the company versus the total amount of equity that shareholders have committed to the company. And typically you'd like to have a low debt-to-equity ratio. However, you have to keep in mind that the debt-to-equity ratio is very industry specific. So you might look at a set of financial statements and take your liabilities versus your equity, and the ratio might be 8-to-1. So you may have 8 times the debt to equity. You may think, well, that's incredibly high and this would be a bad investment. However, you should get the information on what is typical for that industry. In fact, 8-to-1 may be low in that industry, whereas 3-to-1 might be high in another industry. So you have to have all the information when you're making a decision based on debt to equity.
Can you explain the concept of earning per share and how it works?
So earnings per share basically is your net income divided by the total number of shares outstanding. And this very often, if you have a high net earnings per share, can drive the actual share price in a public market. Obviously, the higher net earnings per share, the more attractive that investment is. And consequently, sometimes the lower the net earnings per share, the less attractive that investment is.
Thanks, Tracy. You've given us a lot to consider, and you've also underscored the importance of good accounting practices to the success of any company. Now it's time to close the books on Caitlin's Dog Grooming Limited. This is a very important part of what's called the accounting cycle. Let's review where we're at in the cycle at this point. Step 1. Analyze transactions and record only transactions that have occurred, not anticipated future events. Step 2. Record each transaction by making a journal entry. Step 3. Post the transactions to appropriate accounts in the general ledger. Step 4. Prepare a trial balance which is a simple listing of all the accounts to verify that the general ledger is in balance. Step 5. Adjust any journal entries to correct any errors. Record revenue that has been earned, record expenses incurred, amortize assets, and defer or accrue revenue and expenses now or into the future. Step 6. Prepare financial statements from the adjusted trial balance. This brings us to step 7 in the accounting cycle, which is the preparing and posting of closing entries. In order to accumulate data for next year's financial reports, this year has to be closed off, brought to zero, and new accounts opened for the year following. The process of making these accounts zero is called closing journal entries. The only accounts remaining will be the balance sheet accounts, which are called permanent accounts, since they are not closed on an annual basis. Step 8 is preparing a new trial balance after the accounts have been closed. Step 9 is going out to your favorite bar and getting completely, what else, zeroed. Now, are you ready to recognize and appreciate the basic principles of accounting in your company or the company you'd like to start? Let's give the final word to our expert advisor, Tracy Campbell. Tracy, for a new entrepreneur, what advice would you give?
I think it's really important to get some independent advice. I think that if you're going to start up a business, you should meet with a chartered accountant. Because there's things you want to know in terms of, do you want to start a corporation? Is it a sole proprietorship? Those kinds of things. And I think the best place to go is to go to speak with somebody in public accounting. And they'll steer you in the right direction. They'll say, you know what, this is small, and maybe it can be a sole proprietorship, and maybe what you need is a bookkeeper, and they'll very often give you the names of people to get in contact with, but they'll at least give you the structure with which to start in terms of, and information about Revenue Canada and HST and business numbers and all of those kinds of things, and what your liabilities are, and in terms of a sole proprietor versus a shareholder of a corporation. So I think it's really, really important, if you're planning to start a business, even from the outset, something small, to talk to a professional, and they will steer you on the right path.
Thanks, Tracy.
It was my pleasure. Thank you very much.